Hello and welcome, everyone. Thanks so much for joining us. We are going to give it just another minute for more folks to join on, and then we're going to go ahead and get started. All right, it looks like we've reached critical mass, so we are going to go ahead and get started. Thank you again for taking time out of your day to join us. This is a specialty workshop where we're going to be talking not just about student loans, but the relationship to retirement and sort of broader financial wellness. And we have a really special guest on today that I will be introducing in just a second. Before we do, just a few housekeeping notes before we proceed. First of all, we are recording this workshop and everyone will receive a copy of that recording following today's session. So if you have to step away or get distracted at any point, not to worry. Again, you'll receive a copy of that recording. That being said, I know I speak for myself and our guest, Kevin, who I'll introduce in just a second, but we really want this to feel as interactive as possible, not like we're talking at you for an hour. So with that said, we encourage you to put any questions you might have in the Q&A. We'll be pausing periodically to answer those throughout the presentation. And then if you need to enable closed captioning or live transcription during the webinar, I'll be putting a link in the chat with instructions on how to enable this feature on Zoom. All right, so a quick look at the agenda that we're going to cover here today. First, we're going to do some brief introductions, and then we are going to dive into some of the student loan basics. And this might be somewhat of a refresher for some of you who have heard it before. We're going to touch briefly on income-driven repayment plans, and then the big forgiveness program, Public Service Loan Forgiveness, or PSLF. And then I'm going to turn it over to our special guest, who is going to talk about balancing student loans and saving for retirement, sort of what that means and how you can accomplish it. And then we're going to wrap things up by talking about how to get started with Savi. All right, so for some brief introductions, some of you may be familiar with who I am. My name is Lindsay Clark, and I'm the Chief Borrower Advocate here at Savi. I'm a borrower myself. I have a little over $200,000 in student loan debt between undergrad and grad school. I say that hopefully because it might make some of you feel better about your own situations in comparison, but mostly because being a borrower informs how I communicate about these topics. I know firsthand how overwhelming and complicated they can be. And so my goal here today is to explain these concepts in a way that is really easy to understand, but helps illuminate the path forward, and has you leaving here feeling better than when you arrived. And it's really exciting because I'm joined today by our special guest, Kevin Crain, who is a retirement services and financial wellness expert with decades of experience. And he is here to talk to you today all about financial wellness, but especially what the implications of student loan debt mean for your financial future now and going forward. So Kevin will present in a little bit here, and we'll give you more of an introduction on himself, but we're really, really excited to have him. And just for those of you who might not be familiar, this is Savi. We are your student loan benefit. We are a social impact technology startup based in Washington, D.C. We were founded by student loan experts and advocates who've been fighting on behalf of the borrower for more than a decade. And they realized how difficult it was for borrowers to navigate these overly complicated and complex government programs, like public service loan forgiveness. So they decided to do something about it. And they developed Savi as a technology platform and a human service to help borrowers like you and like me not only better understand our student loans, but to navigate successfully from start to finish around these programs. But along the way, our goal is to make the experience of being a student loan borrower a better one, because I think we can all agree it's not great. So we try to do that by identifying as much additional savings as possible on a month-to-month basis through things like income-driven repayment plans. But at every step of the way at Savi, we like to think that borrowers, not their student loan debt, are our top priority. There are a lot of companies and entities in this space that are purely there to service your debt, make money off of your debt, and that's not us. We're there to serve you, the borrower. We consider ourselves advocates, and that's why I have the title that I do as Chief Borrower Advocate, to make sure that we are creating a better world policy-wise for student loan borrowers, but helping each and every one of you get to that finish line. And we're here today because you all have access to Savi as an exclusive member employee student loan benefit. We partner with some incredible organizations across the country. You can see some here on your screen to provide our tools and services to employees, members of that community to try and help them with their student loan debt. And the best part of all is that it's not just available to you, the borrower, it's also available to your family members as well. So if you have a spouse, child, you name it, with student loan debt, they are able to take advantage of Savi, and I'll show you how they can do that at the end of the presentation. All right, so with introductions out of the way, we are going to dive right in. First up, we're going to talk about income-driven repayment plans, or IDR. So before I go into what income-driven repayment plans are, I want to sort of back up a second and give some basic context as to how repayment works in general on your student loans. So when you graduate and you go into repayment for the first time, usually you have about a 6-month grace period before that first payment is due. And you get that first statement in the mail, and it reflects you as a borrower being automatically put onto what's called the standard repayment plan. And that standard repayment plan calculates your monthly payment on two things and two things alone: how much student debt you have and a 10-year payoff horizon. So, someone like myself with a little over $200,000 in student loan debt on that standard plan, I'm pretty sure my monthly payment came out to around $1,800 a month, something along those lines. Really unaffordable for most people, myself included. And so the Department of Education and government over the years and decades realized that many, if not most, borrowers could not afford their monthly payment on the standard plan that was based on how much student debt they had. So they introduced what are called income-driven repayment plans, or IDR. And these base your monthly payment on two entirely separate things: your income and your family size. So you could have $500,000 in student loan debt, it wouldn't matter. As long as you are on this plan, it's going to be looking at a percentage of your income rather than how much student debt you have. Okay. Now, before I talk about how they generally work, I think it's helpful to just know structurally that there are sort of primary types of income-driven repayment plans. You have the pay plan, the IBR plan, and ICR. Now, you all might have heard about the SAVE plan. This was the newest income-driven repayment plan introduced by the Biden administration a couple years ago. Unfortunately, due to lawsuits that put that plan on hold, you can't currently enroll in the SAVE plan. So there are only about 3 that you can enroll in. So it's just helpful. Income-driven repayment is sort of the umbrella term here, and then there are different types of income-driven repayment plans. But they all generally work the same way. They look at about 10 to 20% of your discretionary income, okay, and they cap that monthly payment based on that income. Now, what is discretionary income? Well, part of your income is set aside to cover the cost of living. That leftover amount is called discretionary income, and that's what that payment's based on. If you're looking at your tax return, this would be your adjusted gross income, or AGI. So I'll give you an example. Let's say you file your taxes as single with no dependents and an income of around $52,000 a year. That's going to come out to around $160 a month on your average income-driven repayment plan. Now, for every child dependent that you have, that can typically lower your monthly payment by about $50 per child. Even unborn child dependents can count. And it's sort of a sliding scale from there. The higher your income, the higher your monthly payment. The lower your income, the lower your monthly payment. And if your income is low enough, under about $25,000 to $30,000 a year, you could qualify for as low as a $0 monthly payment. Now, in order to enroll in these plans, there's an application that you have to fill out. And with that application, you have to attach supporting documentation attesting to your income. This can either come in the form of your most recent tax return or a pay stub from the last 90 days. That gets submitted to your servicer. Your servicer says, okay, Lindsay, you're going to be on the pay plan at $160 a month. And it locks that in for 12 months. 12 months comes and goes, and you have what's called a recertification deadline. And by that deadline, in order to maintain yourself in the program, you need to simply resubmit that application with updated income documentation. And then they'll do that process again. They'll review it and say, okay, Lindsay, you're on the pay plan. Now you're at $180 a month, right? So the implications being any fluctuations in income from year to year will result in fluctuations in that monthly payment amount. The other thing about income-driven repayment is that you are also eligible for forgiveness after payments for a certain amount of years, usually 20 to 25 years worth of payments. Now, I just want to clarify that this forgiveness is different than public service loan forgiveness that we're going to talk about in just a second, okay? Um, this forgiveness is exclusive to income-driven repayment plans, okay? But because the remaining balance can be forgiven, the implications are that you want to try to minimize your monthly payment to maximize that forgiveness. How long you pay for depends on a few factors, like the plan and the loan type. So, with the pay plan, it could be 20 years. For IBR, it could be 20 or 25, right? We're not going to go into all the stipulations here today. A lot of it comes down to your plan and your loan type. The great thing about Savi is that it's going to be able to identify for you which is going to be best. But when it comes time for that forgiveness, no application is needed. It occurs automatically. But one of the key things about these income-driven repayment plans is that, again, it looks at your pre-tax income. And when Kevin talks a little bit, when we talk about ways to maybe reduce that pre-tax income, right? Contributing to your 401k, things like that, right? Are all going to decrease that pre-tax income. And what that's going to mean is a lower monthly payment on your student loans. I know it's somewhat counterintuitive, but I know many of you who don't contribute to your 401k or savings and putting money aside because you have those student loan payments. Well, this could actually help to lower that monthly payment, right, on an income-driven repayment plan. So that's just sort of a concept we want to put in your minds right here today. All right, we're now going to move on and talk briefly about public service loan forgiveness, PSLF. And again, this might be a refresher for many of you, but for some, it's always good to sort of become reacquainted with the rules of the program. So PSLF is essentially full forgiveness on the remainder of your loan balance, whatever that may be. It could be $5,000, it could be $500,000. It doesn't matter. Tax-free. This program is tax-free in perpetuity after you have made 120 qualifying payments. Now, whenever I say qualifying payments, I'm really saying it in air quotes because the devil is really in the details as to what constitutes a qualifying payment. And it really comes down to satisfying these three things that you see on your screen right here simultaneously. Number one, you have to work for a qualifying employer. This is any government organization at any level, federal, state, local, or tribal, or any non-for-profit 501c3. The only stipulation here is you must work a minimum of 30 hours or more per week. However, you can combine multiple or part-time employment to qualify, so long as all of the employers that you're combining are eligible. So let's say you work part-time at NYU and part-time at Fordham universities. Both are qualifying employers, they're 501c3s, and so long as combined you're working 30 hours or more per week, you can qualify for the program, okay? The last thing I'll say about employment is that it is retroactive going back to October 2007. Why October 2007? Well, that was when PSLF was signed into law. So any qualifying employment that you've had from October 2007 to present day is fair game for the program, okay? And you could have had multiple employers over that period of time. So that's number one, qualifying employment. Number two, qualifying loan type. you need to have a federal loan, but not just a federal loan, what's called a direct federal loan. The easiest way to tell if you have a direct loan is it will literally say the word direct in that loan title or DL, which stands for direct loan. If you have a non-direct loan, such as a FFEL loan or a Parent Plus loan, you will need to consolidate these loans into a direct loan in order to qualify. Okay. So that's number two, qualifying loan type. And then number three, you need to be repaying that loan on a qualifying repayment plan. And the only types of repayment plans that qualify are income-driven repayment plans. It could be any one of those three that we talked about, pay, IBR, ICR, doesn't matter, just has to be one of them. And you need to be making that payment for the on time and full monthly amount. So after you have satisfied all three of those things and made 120 payments while satisfying those three requirements, you are eligible to have the remainder of your balance forgiven. Now, I'll always like to clear up some common misconceptions about these 120 qualifying payments. First off, they do not need to be consecutive. You just need to make 120 total cumulative qualifying payments. So let's say you worked for a qualifying employer for 2 years and you accumulated 24 qualifying credits. And then you left. Maybe you went to go work in the private sector or you took some time off. Nothing happens to those credits. They simply pause. And if you were to ever resume your eligibility by resuming work for a qualifying employer, you could resume accumulating those credits towards the 120. Okay, so again, they do not need to be consecutive, just cumulative. However, you can only receive one qualifying payment credit per 1 month per one payment, meaning you can't double up on payments in a month and get double the amount of credits, or you can't make a big lump sum payment and get more credits than you normally would. The easiest way to think about it is this. In any given calendar year of 12 months, the maximum amount of PSLF credits you can receive is 12. So if you have to get to 120 total, right, and you can only receive 12 a year, you are all very smart and can do the math here. That's 10 years minimum, right, before you would be eligible to receive forgiveness under this program. And that would be if you were making the payments consecutively, which again, you don't have to, all right? So when it comes to applying for public service loan forgiveness, there is one form and one form only, and it's called the Employment Certification Form, or ECF. This form needs to get signed off by you, the borrower, and then it needs to get signed off by your employer, any current or previous employers you might have had. So let's say you currently work for a qualifying employer and you've previously worked for two qualifying employers. That means you're going to need to submit three of these forms, okay, total. That form gets submitted to the Department of Education. They review it and they say, okay, Lindsay, you've got 50 credits as of the date that form was signed. And then each year going forward, and this is what we recommend, you are going to want to submit another one of those employment certification forms so that you can keep continuing to accumulate credit towards that 120. Okay, you definitely don't want to wait until the end to when you think you've hit that point. You want to do this on a continuous basis, and I would recommend each year. And that's how you can sort of get to that finish line of 120 qualifying credits. All right, so we just did a sort of a brief refresher on income-driven repayment plans. Again, can be a powerful way to help lower that monthly payment, right? And set you up to hopefully have those loans forgiven under a program like public service loan forgiveness. I know many of you work for qualifying employers on this webinar here today. So at this point, I'm going to turn it over to our special guest, Kevin Crain, to talk about balancing student loans and saving for retirement and broader financial wellness. He is a wealth of knowledge, and I'm going to turn it over to him now, and he'll introduce himself. But Kevin, we really appreciate you being here, and I hope as many of you as possible ask some questions in the Q&A because this is sort of a rare, unique experience for us. So, Kevin, take it away.
Thank you, Lindsay. That was great. Very informative. I learned a lot as I listened to that. So I'm going to introduce myself. I'll give you an outline of what I'm going to talk about. And as Lindsay said, would love it to be interactive based on what you've heard in terms of questions you have. In terms of a further introduction, I spent many years in the financial services industry. I've spent 40 plus years in retirement services, greater financial wellness, in terms of doing numerous efforts in there. My last employment was at Bank of America Merrill Lynch, and now post somewhat retirement, I'm involved in the industry in a number of different advisory ways. Um, have done extensive work on financial wellness. And what I'm going to talk about today is really around that topic, which is the balance, as Lindsay said, between all of you wanting to be financially well, and obviously managing debt is a primary factor in that. I'll talk about that. But also the other side of things in financial wellness, which is for the long term. Do you have an ability to accumulate savings for the long term? And there are some promising advancements in the retirement space in terms of ways you will have opportunities to do that balance and to do that. So I'll talk about that. I've also spent time doing a lot of research on and trying to help employers on how should they help their employees with all of this, with financial wellness, with education, with planning, with even the types of plans and benefits that they offer. And I've done work in Washington on the design of some of the things I'll talk about and what is being done in Washington to both understand what people are going through, but as importantly, to create meaningful solutions to help people to continue to feel they have the ability to be more financially well, not only in the immediate term, but in the long term. And then last, in terms of introduction, I am a proud advisor to Savi and the work that Lindsay and the Savi team are doing, because I think in what she just went through and other things they do, it all with student debt, it all starts with the understanding and the education of getting people well equipped about what is out there and how they could manage it so they can move on to actually take action. So let me start with just in general, the framing, as Lindsay said, of this topic. Um, there's been a lot of research. I've done a lot of research on this, and there's no doubt, and I'm sure many of you on this call would nod your heads at this. Full-time workers feel a lot of stress. Um, they feel stress around money. They feel stress around physical, emotional. Those things come together. But on the financial stress side, there is a prevalence of financial stress across all income groups, genders, age groups. It's not just one particular population. One of the leading reasons when you ask people around why are they feeling financial stress is debt. Uh, Probably not surprising, particularly on this topic, but debt's usually the leading reason. Now, when we talk to employees and we ask them in understanding that if your employer gave you more help with student debt, education, planning, even maybe some financial ways to help you with the student debt, would you avail yourselves of that? And close to 50% of employees said yes, they would feel very positively about that and they would engage and use that. So, there is this paradigm. And what I'm talking about today is student debt has had a particularly difficult connection to the longer term of people being able to save for retirement. So what's happened is, and I'm going to speak about something in a very promising way beyond what Lindsay talked about, all the great services Savi does that the government just recently did, which is people have student debt, and if they can't get relief from it, they have to repay it, and there's no way to escape that. Well, you have that on one side as an individual, but then your employer says, hey, good news, we have this great retirement savings plan. If you participate and you save money in it, you can get a pre-tax benefit. Oh, and by the way, most employers would say, and if you save money in it, we will give you a match on your contributions. That's great, but you're asking that individual to balance those two things. And in many cases, they may not have the ability to save in the retirement plan because they're doing what they have to do, which is on the debt side of their financial life about repaying their debt. That has been one of the biggest issues. And I think up until recently, some things that have been done, I think it was unfair to ask people to say, hey, you have debt over here in short term, you should take care of it. Oh, by the way, you better do all these great things in your retirement plan and save all this money for your long term. That I think caused people a lot of stress because they're like, I don't know how to do those two things and balance them without some help. So what had happened over the years, employers have definitely taken a greater responsibility and interest in financial wellness. If I had talked about this a decade ago, I would have said employers will say the words, but it may be hard to see the actions. Employers are now taking a lot more action around helping employees' financial well-being. Now, there's a vested interest in that for employers. As I said earlier, if an employee is left to themselves to handle their financial life and they have financial stress, and they have significant financial stress, maybe coming from debt, I can almost guarantee you there will be an effect on their emotional well-being. There will be an effect on their physical well-being. There will be an effect on their productivity at work. So it is an imperative for employers to do this, not a nice to have. It is an imperative for employers to take more responsibility. And yes, obviously, as an employer, there's a benefit coming to them, but more importantly, it's for the good of their employees in terms of giving them the opportunity to manage this much more in a much better way. So employers have more definitively done things around in retirement savings. They offer retirement savings plans, 401ks. They offer employer match. They may offer a health savings account in terms of a way to defer later healthcare expenses and pay for them. They obviously offer health insurance. They're now even stretching out into caregiving benefits, emotional wellness benefits. But the biggest topic, because of this understanding now of their knowing that debt is becoming a big issue, is to really advance wellness programs around debt management. But the biggest advancement in employee benefits right now is around student debt, understandably. So let me speak about, in terms of evolution, positive evolution, some of the things that are happening. One of the biggest things that has happened in partnership with the financial services industry, the employers, and the government, and I'm going to be optimistic here. Actually, those three entities did come together, did listen to each other, and actually did something. And even in Washington, surprisingly, they did something really strongly bipartisan. They passed two big retirement security acts called the Secure Acts in the last 5 years, and with tremendous bipartisan vote, which I know is rare these days. One of the biggest features in those acts were what is called a student loan match. So if you remember what I said earlier is it was left to the individual to say, hey, you're repaying your debt. Oh, by the way, if you want to get a match contribution in your 401k, well, you need to find money to contribute to the 401k or you won't get that match, which presented a really insidious issue for the employee to try to get long-term savings. This provision tries to solve that issue. So what it says to an employer is the employer can match in the retirement plan an amount of money matching against what the individual is repaying for student debt. So meaning the employee no longer has to also contribute to the retirement plan to get the match. The match in the retirement plan and the monies are put in is recognizing that the employee is using their monies to repay student debt. This is just rolling out. This is just starting. So what you'll see is employers, the employers you work for, will start to adopt this, start to put it in plans, will educate on it. There will be planning tools. But this, as we go along, should be a major win when you look at the balance between student debt and debt management and retirement savings. That's one feature. The second feature is employers themselves outside of the retirement plan, this match feature, can choose to give an amount of money to employees outside the retirement plan, an annual amount that the employees can use to somewhat offset their student debt. And this has some positive tax consequences. This was a benefit that up until these Secure Acts had a time period of the positive tax status on it. That time period has now gone away, meaning in a good way, it's a more permanent tax benefit. So this is another way for the employers to tangibly and financially try to help and support their employees with student debt. Third, and this is evidenced by what Lindsay just did. Um, a big part of financial wellness programs is more holistic education and coaching. And when I say that, it's not just, hey, you as an employee, the employer says, we offer a 401k, come to a session and learn about the 401k, or we offer an HSA, learn about that. I'm talking bigger now. I'm talking offering employees savings and budgeting counseling sessions in general. Like, how do you balance your debts versus what you need to save? Um, Workshops, one-on-one sessions, virtually, in person, to really have people think overall about budgeting, spending, debt repayment, refinancing, and things like that. So financial wellness is now broadening to bigger topics and not just purely associated with the specific benefits that the employer offers. There is also programs around that, but it's now trying to help people think more broadly first. And then, they can dig into the deeper details of the benefits they're being offered. And I think, what Lindsay just did there would be an example. And one of the more popular seminars being created in financial wellness with employers is student debt management, exactly to the heart of what Lindsay and Savi are doing and why they're working with many employers. Fourth, um, navigation help, meaning um, we're entering a world of more and more things are done digitally. And because people like that, they want to look at planning tools digitally. They want to do what if analysis. So that those advancements are now continuing. When you see within the banking industry, where you do your banking, there's a lot around budgeting and expense management and debt management. So digital tools are becoming more robust to allow people to do lots of modeling, personalize that to themselves. And what you're going to see as a next generation of that is artificial intelligence's role to help people also and more personalize that. So those are the big things when you look at kind of the employer world and what's going on. As I said, and I'll reiterate, the most important thing in this is that it has to be a partnership, including the government, including policy and positive regulations. I took you through the student debt match, the tax-free employer loan help. So those are starting points. The good news is the government is now tangibly doing that. They're going to do more. There'll be more done because at the end of the day, the most pressing issue for people when they look at stress is around debt management. And there are stories every day around this in general. So last, I would leave you with how do you look at this, in your chairs as employees, and what do you do about it? First, you've heard a lot today around all these different programs and opportunities. I would definitely make sure you understand and can get information around what your employer is offering for financial wellness, and what types of counseling and education sessions there are, and take advantage of those. I will say employers are pressing very hard, rightfully, on the companies they deal with that sponsor the benefits, that service the benefits, to help the employer significantly with financial wellness programs. And obviously, Savi's an example of that. So understand and look, at your intranet, corporate intranet, where your HR programs are listed, and really see what's out there. Second, you're in probably annual enrollment time right now for healthcare, or you're finishing it up. That's also a time period employers communicate more around these general wellness programs because, again, it's a good time to communicate that, because it is all about overall wellness. And as I said earlier, there is this intersection of financial well-being, physical well-being, and emotional well-being. So you may hear more, particularly in this time period, as you're working through your health enrollment and what they call open enrollment, more about these programs. Um, Third, um, there are things, as I said, being done that you may see in your benefits programs around more specific student debt